day trading education about when to exit your trades. I'm going to give you a very simple, also logical explanation here. Don't need anything fancy, so let's get right into it. All right, so we're looking at a chart of Apple intraday 3-minute bar, and here is the dealio. So a lot of people falsely assume that your entries should be based on a lot of volume coming into the market, that is a good signal for entry, and that is exactly 180 degrees wrong. So if you've ever felt like, God dang it, if I just took the opposite side of all my trades, I'd be a millionaire, there's probably something to that. I think we've all had that experience and had that feeling. So, and this is one of those instances. So when you get out of trades, well, you get out of trades when big volume comes in. You don't get into trades when big volume comes in. You get out of trades when big volume comes in. So let me show you what I'm talking about. So price comes down, 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 down. Here we see big spike in volume. And that's right around the time, of course, that the market goes ahead and puts in its low. So if you're short here, you watch for the volume spikes. I call these volume spikes. And they come in. And boom, that's the end. Okay, here's another volume spike. And by the way, these volume spikes should be really just clear to the naked eye. All right, so then again, we see that this is dramatically higher than the previous volume, about double. If we go up here, we'll see, where do we match that bar? Right about there. Okay, and that was coming into the end of the move. So again, that's where we come into a high. We don't want to buy there. We want to get out there. That's a great exit signal. All right. Again, here's another one. Big volume coming into the market. So if you were short, good time to get out. All right. Here's another one. God dang it. These just keep happening. Now we got a couple of them together here. Big volume bars. And if we go and we look up there and try to match this puppy, matches right about to that puppy there. And kablambo, again, if you were long, nice signal to get out. Now, one thing to notice on this, it actually gives you an early signal to get out. And that's what we want, early signals. So if you're short, you see the volume comes in, okay, the big volume spike, but then the price goes down just a little bit further right after the volume spike. Same thing here. After this volume spike, price continues to go up just a little bit more. After this big volume comes in, price continues down just a little more. After this big volume spike comes in, price goes up just a little bit more. So it's an early signal. Don't you love early signals? So do I. And there you go. Nothing unique, nothing special, nothing proprietary that you need to use. So why does this happen? This is one of the questions. What's the logic behind this? And the logic is that people come into the market, usually, especially professional traders, usually come in with what's called accumulation. And then, so they're coming in and they're coming in with size, a little bit more, a little bit more, a little bit more. And as the market continues to move, they bring in more contracts, shares, lots. But when they get out, they usually will get out. And it's not just one person or one trader or one company or one hedge fund, by the way. But what happens is exhaustion. And when a lot of people, a lot of traders, frankly, it's a lot of money, all decides, okay, we're getting out, capitulation happens or exhaustion, and it comes in at the same time. And part of the reason for this is, well, the old slogan, the trend is your friend until the end. So it's at the end of these moves that the masses start getting nervous about it continuing, and they're thinking along these lines, oh gosh, been in this for a long time. We've made some good money. They want to pocket the money. They want to lock in those profits. And so then people start getting out en masse all at one time.